Welcome back to Happy Investors with this time a new update on unique companies to buy for the long term. Every month we provide a new analysis of several interesting unique companies with a sustainable competitive advantage that also score high on the factor analysis. The factor analysis isn't everything, but it gives us some direction for potential interesting entry points where a high factor analysis means they could outperform. What does this Monday update entail? That every month we look at countless stocks that I've filtered through this screener, all researched based on competitive advantage, that we highlight those with the highest scores in terms of analysis. Factor analysis doesn't say everything, but it gives us an indication based on statistics. Of course, it always comes down to the fact that you need to do your own fundamental analysis. My name is Jorik Vermeulen. I've been investing for over 10 years, and through these videos from Happy Investors, I try to help with simple investing for financial freedom. Let's take a look at the first stock that is unique and potentially interesting in terms of site potential. Nudie.com is a very interesting company from China, a holding company in e-commerce and logistics, and the company has a strong, sustainable competitive advantage. Not only that, it also scores very high on the factor analysis, and it has been doing so for actually more than a year. The Morningstar rating is 4 stars, and they give a fair value estimate of $50 compared to the current price, which is lower at around $40. That possibly means a margin of safety. Winnative Ratings gives roughly the same kind of price target, around 50. That means there's still not 70% upside potential. Now, I know GD.com quite well, but I don't invest in individual Chinese stocks myself, simply because it's too far away. That's why I invested in the QB ETF, which is a China Internet ETF with 25 of these types of companies: GD.com, Alibaba, Tencent, Baidu, all very interesting, and that choice made me. It's worked out well because since the summer, I've sold a lot more American stocks and invested much more in European and Chinese stocks, with about 10% in the China Internet ETF. And part of that has also been converted from US stocks to cash, and that has worked out well. And yes, I hope the market correction continues because we can buy more at lower prices and become financially free in the long term. And GD.com is interesting, so if you want to take a chance on it as an individual stock, it looks good. Looking at some statistics, we can see that the historical valuation really does seem to be significantly undervalued. And you don't see this kind of charts, for example, with Google, Amazon, or Apple. The stock price is well above what would normally be considered fair value. And here with Chinese stocks, you see the opposite, and that represents a potential margin of safety. Average returns can really add up. The price to earnings ratio is only 9 for next year. The EPS estimates have been set by numerous analysts. So yes, we can assume that consensus might hold some truth, although that certainly isn't a guarantee. Now, let's say the price goes back to a price to earnings ratio of 15, which seems very acceptable for this company. Then it would have an upside potential of about 30% per year. That's very high. The normal multiple is actually a bit higher at 26. That even means an average return of 60% per year. Super high, of course. Yeah, whether all of that will come true, no idea. But GD.com has good prospects, we can say. And it really can be an interesting story. Look at the valuation, for example. So the price to earnings for next year is around 10/9. The bad luck ratio is around 1. But look at the EV to sales, or the price to sales, or the price to cash flow, all very low. And compare that to the US tech stocks, which are all many times higher. So those are serious matters. Moreover, GD also has a lot of cash on hand. It all looks like it's too good to be true. But those are just the statistics. The only thing is the geographical and political risk, of course, with China. There's always uncertainty. On paper, oh, this city really looks great. And yes, unfortunately, I'm not in China myself, so I can't verify how the company's doing. So that's always a risk. That's why I personally invest in an ETF. Just a bundle gives a bit more certainty, but that's purely to cover my own ignorance. So maybe you're smarter and know more about GD.com. I'm curious, let me know. Looking at the good numbers, they also look impressive. And if we look at profitability, it's not very high, 3.5%. But we look at, for example, the return on equity and the return on total capital. The return on equity is positive, but the return on total capital is not. So this is a less positive story about GD.com. They generate a lot of cash flow, which is all very good, but ideally you'd want higher profit margins, which also indicates a stronger competitive advantage. But GD.com is definitely still growing. Looking at the very short term, Zexcrank indicates that for them it's a hold, Why exactly? No idea because the price is way below theirs. Price levels? Oh, I was looking at Bellwing brands, but let's take a look at the chart of GD.com. Based on technical analysis, we can see that it has indeed risen significantly, but it was actually following the Chinese internet ETF quite closely. And you see that for the long term, there is absolutely no certainty that it will continue to rise. Imagine you believe in charts and it goes back to the all-time high. That still means there's quite a bit of upside potential, like around 50%, maybe even yes. But that's all just looking at charts. So it could very well be that GD.com will rise in the long term, but there's always that uncertainty about China. In any case, the cards look good, and if we look purely at the valuation and the PE ratio, it could be worse. Sea Limited is a unique company that currently scores high on the factor analysis and has particularly impressive momentum. While many companies and big tech firms are declining, Sea is on the rise. What's going on with Sea Limited? Now, this company is known, among other things, for online gaming with their name Garena, a kind of online gaming platform. And recently, the company has further diversified into digital finance and also e-commerce. To be that good, Z, it always has to prove itself, of course, but the company is definitely a lot bigger and more comprehensive than it was before the all-time high, and at least the price is still quite a bit lower than the last price. From the Morningstar 4-star rating. Why? According to them, the economic moat is narrow and the fair value estimate is significantly higher at $160 compared to the current price of $122. Definitive ratings, a price starter that also lies around the fair value line from Morningstar, means a 60% increase, and that after an already impressive 200% increase. Looking at a bit of historical valuation, then the stock still seems overvalued. Also, when we zoom in a bit, the current price to earnings ratio is still around 60, but we'll soon see that the profit margin is relatively low. Low profit margins can quickly rise, which can also cause the multiple to drop faster. Moreover, it has strong momentum in terms of revenue growth, and that's of course important. Let's look at an estimates based on the current valuation. Well, that lost earnings seems to have increased a bit. It looks like 60, and of course the lower the better. But yeah, you never really know what the right price is in the short term. That's why you need to do your own intrinsic value calculation based on discounted cash flow. We see below EPS estimates from analysts. Well, a whole lot of analysts are setting their targets quite high. So these are impressively good figures regarding earnings per share. Well, if that's the case, you could indeed reasonably assume that a price to earnings ratio of 30 is acceptable. Unique companies often have a price to earnings ratio of around 25, sometimes higher, sometimes lower. But if you assume that 30, which is on the high side, then the average potential return compared to the current price level is somewhat limited. If you assume a lower multiple, let's say 24, then the average return is only 3% per year. And a lot can obviously go right or wrong here. It's mainly about this EPS development. If it goes faster than expected, Sea Limit will be able to realize much more profit. Look at the valuation. Well, that has increased significantly. So the estimates are around 60 to 50 for next year in terms of price to earnings, but the failure rate comes down to 0.6 in the model. And because of that, it gets a strong buy rating, as it also has very strong momentum compared to other stocks. But whether this is really the best entry point for Sea Limited is always up for debate. The growth figures look very impressive. Yes, it speaks for itself. You should look at the EPS. Long-term growth is even projected at 50% exactly. That's very high, while the current profit margin is relatively low. Still, return on equity and such are all low, but the company that has invested in the future is finally starting to grow long-term and also make a profit. That's an important turning point. It also gives more confidence to certain investors. In the short term, Zexrank gives a hold, and if we look at a bit of technical analysis now, that we know the entire market is significantly declining, Sea Limited is not. Sea Limited is rising, despite the overall market decline. What we see here are actually two peaks. Could it be that the further decline in the stock price is starting? It certainly seems that way. It could be that Sea Limited, because it is already very volatile, might drop quite a bit lower, but that's purely looking at the short term. Then we see that the MACD is about to cross, the stochastic is going to decline, and the price is also going to drop below 1 to 20, but that's all just looking at a few pieces of charts. Because we see based on the fundamental development that the price to earnings ratio is a bit on the high side, but the profit growth can be impressive, so it could very well be that if there is a short-term decline, that could be a nice entry point. How far the decline is, I have no idea. The market must also show that, but as you know, Mr. The market often reacts exaggeratedly in the short term, allowing you as a long-term investor to benefit. The stock of Berkshire Hathaway doesn't need any further explanation about what the company does. Holding company, of course, led by Warren Buffett, the famous investor. I do wonder what will happen when the best man passes away. What will happen to the stock of this company then? He himself indicates that there is enough diversification in terms of chatting. People can't just take over leaders, but you know how the market can react in the short term. The current price is around $490. Looking at some analysis, the analysts indicate that their price target is 6% higher with a price target of $500. 26. 26. Looking at Morningstar, they give it 2 stars. The economic mode is now narrow, and the fair value estimate is slightly lower than the current price. Yet we will soon see that the factor analysis indicates a strong buy, so the question is why? Looking at the historical valuation, it seems that the price is indeed quite high. I wouldn't say it's exaggerated, but it's on the expensive side. The price to earnings ratio is around 20, while the fair value estimate for the company should actually be closer to 15. But the normal multiple over the past 5 years is high, around 22, possibly also due to the popularity of the best investor in the world, Warren Buffett. But it is, of course, a great holding company for the long term. But still, the upside potential with $1 trillion in market value does seem a bit smaller than usual. And they have also indicated before, including the late Baltus, Geordie Munger, and Warren Buffett, that if they can achieve an average of 10%, then they are already satisfied. But maybe there's more upside potential to be gained because they have recently sold a lot, and as a result, their cash position has increased. So the cash position has increased to over $300 million. So the net cash position is around $200 million if you subtract the total debt from it. And of course, if the prices drop, then Berkshire Hathaway can benefit greatly from that and thus achieve a higher return. At first glance, the stock doesn't seem all that interesting. Looking at those valuations, it seems like it's a bit more expensive. The price to earnings for next year is around 25. EV to EBITDA is actually quite cheap. Price to sales, yeah, it's a bit around the sector median. Price to cash flow is on the high bottom side. Of course, it has a number of fundamental advantages like leadership, but that can also come to an end. You know how that might develop. Let's take a look at the revenue growth. Not much to mention except that the leverage free cash flow is positive. Strong profitability, of course, is a continuation of competitive advantages. And of course, a big advantage of Berkshire Hathaway is that they can buy companies that are not publicly traded. And they are always looking for value bargains. So we are very curious about what they are going to do with the class position. It has a strong BBOS of factor analysis. It could mean that, according to statistical models, it predicts a higher, better return than average. And it has performed strongly because many stocks have dropped by 30, 40, or even 50%, while Berkshire Hathaway has actually risen. Well, due to that recent increase, maybe the upside limit, the upward potential, has probably become a bit lower. Zexrank indicates a hold. Their price target for the next 6 to 12 months is indeed higher than the current price, but it's not by much. And we also see that, yes, while many growth stocks have had corrections, Berkshire Hathaway has only continued to rise, only a small decline in the very short term. But yeah, if Berkshire Hathaway were to ever drop by 20%, historically speaking, that's already quite a lot. And every drop of about 25 to 30% is, of course, just an extra buying opportunity for Berkshire Hathaway, which is essentially a long-term holding. And basically, they have now become so large with so many different, yes, companies. Actually, it's something you can see as a diversified ETF, more or less. But hey, that's just my personal opinion. I think it's difficult to achieve a consistently higher average return with Berkshire Hathaway. If you compare it, for example, with an ETF like the Invesco QQQ, just an internet ETF, which probably has a bit more volatility, but maybe also more long-term growth than Berkshire Hathaway, just because they have become so large. But anyway, it's time to learn at this moment. Trunk biobasal factor analysis promising. So personally, I wouldn't go for it. I held Berkshire HWA shares for a long time, but I sold them because the upside potential has decreased. That's my opinion. I'm curious, what do you think of the stock? Let me know in the comments.